When it rains, it pours. Tax regulations and guidance are dynamic, continually changing domestic and international financial waters. Step under Withum's umbrella to better weather the storms of trending taxing topics. We'll share the essential news and information you need to prepare for what's ahead.
Success is achieved through effective teamwork, whereby each other's strengths are multiplied.
And the sum is truly greater than its parts. Think 1 + 1 = 3. Withum's talented accounting and advisory professionals add value to every client relationship with our dynamic approach to problem solving,
delivering exponential results through collaboration and trust. Our strategy starts with an industry focus to provide all the traditional accounting services you require, plus a whole suite of advisory solutions that will level up your success.
like cyber and IT security solutions to safeguard your digital assets, providing peace of mind in an interconnected world.
AI and Microsoft Cloud solutions that will empower your business with a flexible, scalable infrastructure while unlocking the potential of artificial intelligence that will transform how your business operates.
ERP systems and process automation solutions that will integrate and optimize your business processes while reducing repetitive tasks.
Specialized tax and wealth management strategies for businesses, family offices, and private clients that can help reduce tax liability and maximize after-tax cash flow, covering your needs from local to global.
Outsourced accounting systems and solutions that will streamline all or part of your financial operations, giving you the support you need.
Forensic valuation and investigative services for when complexities arise and you need experts who provide clarity in legal matters.
And M&A and business management consulting. We're by your side as a trusted advisor for when you're considering a merger, acquisition, strategizing for the future, or optimizing current business operations.
Experience the transformative power of Withum, plus you.
That's the power in the plus.
When it rains, it pours. Tax regulations and guidance are dynamic, continually changing domestic and international financial waters. Step under Withum's umbrella to better weather the storms of trending taxing topics. We'll share the essential news and information you need to prepare for what's ahead.
Success is achieved through effective teamwork, whereby each other's strengths are multiplied.
And the sum is truly greater than its parts. Think 1 + 1 = 3. Withum's talented accounting and advisory professionals add value to every client relationship with their dynamic approach to problem solving,
delivering exponential results through collaboration and trust. Our strategy starts with an industry focus to provide all the traditional accounting services you require, plus a whole suite of advisory solutions that will level up your success.
like cyber and IT security solutions to safeguard your digital assets, providing peace of mind in an interconnected world.
AI and Microsoft Cloud solutions that will empower your business with a flexible, scalable infrastructure while unlocking the potential of artificial intelligence that will transform how your business operates.
ERP systems and process automation solutions that will integrate and optimize your business processes while reducing repetitive tasks.
Specialized tax and wealth management strategies for businesses, family offices, and private clients that can help reduce tax liability and maximize after-tax cash flow, covering your needs from local to global.
Outsourced accounting systems and solutions that will streamline all or part of your financial operations, giving you the support you need.
Forensic valuation and investigative services for when complexities arise and you need experts who provide clarity in legal matters.
And M&A and business management consulting. We're by your side as a trusted advisor for when you're considering a merger, acquisition, strategizing for the future, or optimizing current business operations.
Experience the transformative power of Withum, plus you.
That's the power in the plus.
Hello, everyone. Welcome to Withum's annual Business and Finance Symposium Federal Tax Update. We're excited to be with you today and obviously have had a big week and movement in the political elections that obviously will impact federal tax reform. So today we have with us Dan Mayo, who will be presenting alongside me. He is a partner in our National Tax Service Group, and my name is Lynn Mucenski-Keck, and I'm a principal in our National Tax Service Group. So probably most talked about that everybody has their ear open to is, okay, what we know so far about the federal election mean? Then we're going to go through an annual update of some key items that have occurred throughout the year, talk about clean energy credits, and move through the agenda all the way down to the Corporate Transparency Act, which we have been highlighting for months now, but want to make sure everybody is aware of it and is working towards being prepared for that by December 31st. So today we're going to talk about the election update. I'm assuming you all know this, but always good to review. So at this point in time, President Trump has been told that he has won the presidential election. And so there was, it wasn't as close as some anticipated, that we could be waiting days or weeks for a final count. But so at this point, we at least on the East Coast kind of knew by around 11 p.m. Eastern Standard Time that that's where we would be. Next slide. Significant is the Senate, right? The Senate used to be democratically controlled. It did flip. They are saying it did flip. Obviously, they're comfortable right now with 52 Republican senators having been holding their spot or elected in. There are a few outstanding states where we're still waiting on the count in Nevada, Arizona, and Pennsylvania. But obviously, they'll keep the 52 that they've already marked. So they also will be holding the Senate. Next slide. What's interesting, as I think all of you, if you follow this stuff like us tax nerds, you will realize that the House has not been declared. Now, don't jump on me. I know this slide was done yesterday. So as of now, I believe the Democratic count has gone up to 193, and the Republican count has gone up to 209, and the magic number is 218 for control. And believe it or not, this is going to be a really important part of how or when or if we see federal tax reform, whether or not it's going to evolve for a process to occur through the House, the Senate, as well as the presidential elect. So next slide. So some significant changes in leadership, obviously, with the senators taking control of the Senate. We see Senator Thune and John Cornyn are both going to run for GOP leader. That is expected to take place next week. And then we will know who's obviously leading the Senate. And as anticipated, Senator Carpo, I always say his name wrong, I apologize, was the minority Senate Finance Committee leader. And we do anticipate him now that the Republicans are in the majority for taking the head of the Senate Finance Committee. Republican-wise, if the Republicans maintain the House, we would anticipate that Speaker Johnson would remain, as well as the leader of the House Ways and Means Committee, which again is the location where tax reform would come out of, would remain to be Representative Smith out of Missouri. Next slide. So what's interesting and why we're monitoring the House so closely is there was some debate about the filibuster process. The filibuster process that currently is enacted requires that there be a 60 person vote in the Senate to pass law. There was some discussion that would that stay or would that not stay, and the Senator McConnell, who has been heading the Republican Senate for a while now, had promised, and still I think I saw him yesterday evening restate that their intention of the Republican Party is to keep the filibuster in the Senate. So what does that leave us with a tax reform bill? So I'm sure many of you already anticipate that this is not going to be potentially a 60-party vote in the Senate. There's other ways that both Democratic and Republican parties have used in the past to push through tax legislation, which they did indeed use for the Tax Cuts and Jobs Act, which essentially says that you have to go through a budget reconciliation or a budget resolution process. So that if the House flips Republican, or remains, I should say, Republican, they'll have what we refer to as a red sweep or a Republican sweep. A budget reconciliation process can go through. They do not need bipartisan support. And we would most likely see quickly federal tax reform take place. You may or may not be aware that actually Republicans have been reviewing tax reform in small committees, both in the Senate and the House, since May of last year. So they are active and ready to act. And if they have a Republican sweep, have been vocal about that they will indeed have a federal tax reform policy voted on prior, or this is what they proposed, prior to the budget ceiling discussion, which is estimated to be in March of next year. So could move very quickly if we have a sweep. If there is no sweep and the Democrats are the majority in the House, then there's going to have to be some type of compromise for a bill to get passed. And what I would say to you is that's not necessarily meaning that there will be. But regardless, federal tax reform indeed will occur because many of the Tax Cut and Jobs Act provisions are sunsetting in 2026. So if the Democrats take the majority in the House and there is no compromise, we all will be very clear on what is going to happen for purposes at the end of the 2025 tax year. I would anticipate if there was a compromise, there are a variety of things that the Democrats would want to compromise because of that it would be a longer process, that it wouldn't most likely be in the first 3 months of 2025. So that's why the House and the majority party in the House is so important to us. Next slide. This is just, again, Republican Democrat chart. If you've ever listened to a Withum broadcast on this, you've heard Dan and I speak quite a bit about this. The only thing I would point out is what is perceived as Democratic wants. Obviously, it has been discussed for years now about the expansion of the child tax credit. So if we do have a Republican Senate and a Democratic House, that would be one of those bipartisan items that would come to the table, I would presume, along with the expansion and reinstatement of the premium tax credits, or the tax credits that are allowed to provide to people to afford healthcare, government healthcare. Next slide. From a business tax perspective, I think some are breathing a sigh of relief. It would not be expected at this point for the corporate income tax rate to raise to 28%. However, I would say that the Republican Party is not as favorable towards C corporations as they have in the past, and they may be willing to adjust that rate. However, we have seen the president-elect Trump proposals state that he would really want to decrease from 21% to 20%. I still think it will be interesting to see where that corporate tax rate will fall out. But for many of you on the phone who are pass-through entities who receive a 20% QBI deduction, sometimes referred to as a 199A deduction, it looks like we are poised to keep that deduction. And then we obviously have a variety of other items. The most important that has been promoted within the Republican Party is the potential increase in baseline tariffs and tariffs on U.S. imports from China. A lot of debate even within the Republican Party on that, and whether it could lead to a slowing down of the global economy and also start a global trade war, something to monitor. And essentially that would not be part of a budget resolution or reconciliation process. Next slide. And I only bring this up, and we don't necessarily are not as concentrated on the TCJA expiring now if we would have a Republican sweep. But it is important to remember that if the Democrats hold the House of Representatives or receive the majority, we will indeed have a bipartisan need for both sides to come to the table. And what I would anticipate is hopefully we would get somewhere by the end of next year. However, if we don't, for you to say, well, that's okay, everything's going to hold, always remember that regardless of what happens in the next 12 to 14 months, we will have tax reform due to the variety of sunsetting provisions under the Tax Cut and Jobs Act that sunset in 2025. So unfortunately, or fortunately, depending on your stance, we will indeed be working a lot with changing tax policy in the next 12 to 18 months. And it's something that we should be working quite closely with a variety of our business advisors. Next slide. Last but not least, before I hand it over to Dan, we do have some people who are budget hawks that you might have heard the slang term for. But most interestingly, we've talked about this on previous webinars, and we had an overwhelming majority say they are concerned with the federal budget. Unfortunately, it does not appear that is a priority, I would say, as of right now. It doesn't mean it would not adjust going forward for either party, right? Both parties agree that they were going to add additional amounts to the federal deficit. And we're very much approaching two significant items. One, which we all know of, the U.S. might carry more debt as a percentage of GDP than we ever have before. which some point to as being significant, others don't. The second, which we have never seen before, is paying more interest expense to our debtors than spending on our national defense. And so this slide merely shows, without the TCJA being extended, that we were projecting for the next 10 years, 2025 to 2034, a 22 trillion, excuse me, it's hard to say, isn't it, dollar deficit at the U.S. government, which is making some people very nervous. And if you flip to the next slide, you'll see that if we do indeed extend the TCJA, that number is only going to increase. So we're seeing the biggest increase being in individual income tax provisions of adding another $3.3 trillion of deficit in that 10-year period. And that doesn't even include the additional interest expense we'd have to pay in relation to that. So whether or not this will be a sticking point, even if we have a Republican sweep, will there be holdouts in the Republican House, mainly, that would declare they need it paid for? Like, if we're going to extend this, we need a revenue offset. And it's really unclear at this point in time if there will be many of them, and if it could stall the process, but definitely something to keep your eye on as we move forward. I'm going to pass it over to Dan.
Thank you for that, Lynn. It's been my experience that most the political parties generally are most concerned about the budget deficit when the other party is in power. So the Republicans have been harping about the deficit for the last 4 years. I imagine the Democrats will take up that mantle and complain about the deficit for the next 4 years. Okay, so now we turn to an annual update of things that have happened during the year, which you think are notable changes in tax law that would be of interest to the group here today. The first is a big one that we've heard a lot about, which happened in June of this year, was the Chevron doctrine being overturned. And so the Chevron doctrine dates back to 1984, and it's a Supreme Court opinion in the Chevron case, where they established a standard review for challenges to agency regulations, including IRS regulations. And so what that said was a court would first determine if a statute speaks to an issue, and then so they would know when they're testing a regulation to see if it's consistent with the statute. But if there's a gap in the statute or it's ambiguous, then the court would give deference to the agency, in this case, the IRS's interpretation of a statute. Well, in June of this year, the U.S. Supreme Court overruled Chevron, which had been obviously law for over 30 years. And so they overturned Chevron and said that the APA, which is the Administrative Procedures Act, requires courts to exercise their own judgment in determining whether an agency, such as the IRS, has acted within its statutory authority. So rather than giving deference, the courts are going to decide. And the Supreme Court said that statutory interpretation traditionally is the province of the judiciary, not the the executive branch of government or legislative branch, the judicial branch. And so they said courts may not defer to an agency interpretation like the IRS simply because the statute's ambiguous, but that they must respect an agency interpretation when the statute delegates authority to an agency. And we see that often in the Internal Revenue Code. I give an example here of Section 7805A, where it says the IRS shall prescribe all needful rules and regulations for the enforcement of this title being the Internal Revenue Code. So that's a fairly significant development. I'm sure we all heard of this, but it's expected to lead to more litigation. I don't know that it will have a direct impact for planning purposes, but certainly will lead to significant litigation when people want to they're more likely to challenge regulations, and this gives people taxpayers a slightly greater incentive to challenge some regulations as being inconsistent with the statute. Next thing is we're seeing is a significant enforcement effort by the IRS. So if you recall that initially with that Inflation Reduction Act of 2022 provided $80 billion of funding to the IRS, was a huge accomplishment for the IRS at the time. They received that so much additional funding for a variety of initiatives. I think about half of it at the time was earmarked for enforcement. Well, over time, the Congress pulled away from that, and I believe they pulled around 20 billion away. So I roughly say here 60 billion in IRA funding, which is why, if you remember that headline number of 80, it was reduced over time. So the IRS is using that money for a variety of initiatives, including enforcement. And so they're ramping up their efforts to pursue high income, high wealth individuals who have not filed their taxes or have not paid their taxes. And so they're concentrating on individuals with more than $1 million of income and more than 250,000 recognized tax debt. And they said that as of January this year, they've recovered $520 million under this initiative. They've also expanded a large corporate compliance program. And this program uses analytics and artificial intelligence. I sometimes joke when I talk to people and I say the IRS's version of artificial intelligence is Control F, when you're trying to search for something. But they apparently have been using significant data analytics and artificial intelligence to identify large corporate taxpayers for audit. So identifying issues that they might want to dig into further. But this includes the largest taxpayers in the country, with more than average assets of more than 24 billion, average taxable income, a significant taxable income. But they're also expanding that program to, you see here, aircrafts. In February this year, they announced they're going to start auditing taxpayers' use of corporate aircraft. So they're trying to get at that allocation between the corporate and the personal use, right? How much of the depreciation deductions, for example, are appropriate, given that some percentage was used for personal use. So of that plane, they'll say if it was a $50 million plane, was half of it used for business, half for personal, or some other split. So the expansion, the IRS used, again, a lot of that IRA, Inflation Reduction Act money to hire, and they've undertaken significant hiring, particularly in the enforcement arena. And so LB&I, which is the Large Business and International Division, used to be, for those of you who remember, the LMSB, Large and Mid-Sized Business. They changed it many years ago to LB&I. Focuses on large companies. They hired 1,800 employees, which is about a 40% increase from its staff in January of 23. So the IRS is really using that money to invest in its personnel, recognizing it takes significant, multi-year process to train these employees and get them ready to start the full process of auditing taxpayers. IRS transfer pricing enforcement is also going to kick up with the significant new hires, including economists, tax specialists, and revenue agents. The IRS has stated publicly that they're going to be asserting more penalties. So what this really means is if you have international operations or you're related parties and you have transfer pricing issues, you really do need to button down your documentation, make sure it is in line with the regulations, make sure it is done by a reputable expert in the area who is independent and who is able to properly come up with the arm's length pricing to withstand challenge by the IRS. Syndicated conservation easements have been around for a long time. They've been subject to, it's been on the IRS's Dirty Dozen list for many years. The IRS declared it a listed transaction, which is the most abusive form of tax transaction in the eyes of the IRS. The problem came when the two court cases invalidated a bunch of notices, including the notice on syndicated conservation easements, and said that the IRS violated the Administrative Procedures Act, so the notices are invalid. So then the IRS proposed regulations to get at these transactions and to make them listed transactions again. So that was in 2022, and they finalized those regulations in October of this year. So the final regulations identify syndicated conservation easement transactions as listed transactions, and the IRS views that as sending a signal that they're trying to get at these promoters. And these are transactions where a taxpayer purchases land and then donates an easement to a charity. And the IRS, in the words of the IRS, they claim and have inflated appraisals to justify large charitable deductions that the IRS says are inconsistent with economics and reality. Basket transactions have also been identified. So this is a unique form of transaction. I won't spend too much time on it, but these are been around for a while. Again, they were listed, then the notice listing them as listed transactions and transactions of interest, which is similar to listed transaction. They were revoked. These are transactions where taxpayers get together with a bank. They execute a contract, which is styled as either an option or a forward or a derivative, a notional principal contract, a swap. And they try and convert ordinary income or short-term capital gain into long-term capital gain so the taxpayer can get that preferential rate applicable to long-term capital gain, that 20% rate long-term capital gain for individuals. And what happens here is the taxpayer it's a managed account, and that's put into in a wrapper of a financial contract. And the taxpayer is saying that they don't own a managed account, they own a contract. And that contract is, when it's sold, gives rise to long-term capital gain. So this is something they've been trying to attack for a while. And they've issued proposed regs in July of this year to identify them as a listed transaction. Basis shifting transactions is another thing the IRS is going after. These are transactions with related parties using partnerships to shift basis between taxpayers or among taxpayers to achieve what the IRS calls an inappropriate tax result. Again, we could spend an entire hour discussing these transactions, but suffice to say, the IRS issued 3 pieces of guidance in June of this year going after them. So if you see one of these transactions, you just need to know that there are new rules out there that limit the ability to shift basis between related parties. And if you're even in unrelated context, the inability to they try and prevent the ability to shift basis to tax exempt away from tax exempt organizations to other people, to a taxpayer or foreign parties, etc. In October of this year, the IRS announced that they're significantly changing the way they audit partnerships and other pass-through entities like S corporations. So the IRS, again, is using that Inflation Reduction Act funding. They have a new pass-through unit in the LBI to go after these pass-through entities. This new unit is going to focus exclusively on partnerships, S corps, and trusts. And so traditionally, this was split between LB&I and the SBSE, which is the Small Business Self-Employed Division of the IRS. So now they're going to work together. They're going to assemble the agents in the geographic teams. And the goal is to remove the size barrier so they can focus on the issues and go after these issues. They've hired someone as of that's starting in January. They identified an individual who previously worked at Big Four accounting firm. And so they're starting to ramp up the enforcement, which we've heard for years now. Originally, remember back when the Inflation Reduction Act came out, they're going to increase enforcement for individuals making more than $400,000 a year. So we're starting to see that activity ramp up. IRS in August of this year issued guidance about matching contributions related to employee student loan payments. So what this is employers who want to retain talent and what they came up with a program the IRS sanctioned, and now there's rules around it, saying that if you want to match contributions to a 401k, you don't have to match it necessarily to money the employees put in. You can match it to student loan payments, certain qualified student loan payments that the employees make on their student loans. So it's a way for employers to put money into a 401k account on behalf of their employees without requiring a similar matching payment by the employee. So one of these perks that companies give to their employees, and now there's rules around it that were addressed and issued in Q&A format in August of this year. And the last thing I'll mention before I turn it back over to Lynn is the IRS came out in October this year with its priority guidance plan. And this is not a substantive document. It's a list of the issues the IRS intends to issue guidance on in the forthcoming year, fiscal year. So the IRS uses a June 30th fiscal year. And so they identified 231 projects that they want to allocate Treasury and IRS resources to the next year. They don't always get to them, and some of these issues remain on the priority guidance plan for many years. But it does indicate the priorities of the IRS and gives you a sense of where they want to focus the resources. And so if you have an issue that you know is authority issue, you see it on the guidance plan, like, all right, well, something's coming out soon. It can be helpful to have a sense of, the direction, whether the IRS is going to address your particular issue or transaction. So taxpayers look at this. It's also a way to, if you want to lobby the IRS on a particular issue, it's on the guidance plan. It's more likely to be addressed in the near future. So with that, I'll turn it over to Lynn to talk about clean energy credits.
Thanks, Dan. There's a question came through and said, what do you anticipate being the most impactful change for the middle class? I still think that's somewhat up for debate because we don't know where the House is going to be. I would remind you that the President Trump proposals said that they weren't going to tax overtime pay and they didn't want to tax Social Security. And then obviously they support lower income tax rates, but also that includes more income in certain brackets for middle class. So I would keep watching that. We don't exactly know what yet, but there definitely were some promises on the campaign trail that would indicate that those would be some primary targets for the Republicans. So I'm going to move on to the clean energy credits. I think it's important to realize before we even get into any of the spending that many people, I've been to countless conferences, countless discussions in DC, It is not anticipated that this gets wiped out by the Republican Party. What you may or may not know is that while some promote the Inflation Reduction Act or Clean Energy Credit substantial changes because of the Democratic Party, we indeed do see much of the value related to the Inflation Reduction Act impacting red states. So there's some type of pull there. Two topics we've heard come up from the Republican parties of items that they don't really care for. One has to do clean energy surrounding hydrogen, and the other has to do with electric vehicles, although we all know about a relationship between President-elect Trump and Elon Musk. So we're really just kind of wait and see narrative here. But to say that you think it's going to be completely taken away, I don't think is true. And there is some alignment with that. He wants to distance himself from the Paris Accord, which was an environmental agreement amongst many nations to decrease carbon output. And so that could be tied into what we see with changes occurring in the Inflation Reduction Act. Things that I think align well with President Trump in the Inflation Reduction Act is the manufacturing of clean energy eligible components in the United States, and obviously increased manufacturing in the United States. So those are two areas that we're confident we would be highly surprised if they altered them. So going into this, I just like to point out that under the original Inflation Reduction Act, they estimated that they were going to spend about, this is the U.S. federal government was going to provide about $271 billion to get to this potential climate goal that they have anticipated to in a 10-year period. Not that we will meet the Paris Accord, but that we would be striving to get closer. However, we've seen a boom in this market. I can't stress it enough. That now recently they've said, you know what, it's not going to cost 271 billion. It's going to cost 652 billion, and some will eat over the next 10 years, and some are even projecting $1 trillion. So there's a lot of movement going on in this area, and we expect it to continue to move. And this chart kind of shows you where we're seeing a lot of that movement. So obviously the investment tax credit, that's like you engaging in solar, wind, this year, including biogas properties, which are very popular in the Midwest, et cetera. So that's kind of taking a big bracket of this, along with obviously clean electricity production, the clean manufacturing, that 45X credit I was talking about, et cetera. So really something to be aware that it is a big ticket item that probably will be evaluated. Again, not anticipating that it would fully go away. Next slide. These are the major credits that we're dealing with as a firm at Withum with our clients. So when you're thinking of these particular credits, you're thinking about developers, except for the commercial vehicle credit. So we have multiple people involved in solar, biogas properties, combined heat and power systems, et cetera. So that's been very active. And we also have a fair amount of manufacturing clients who are active in manufacturing eligible components, anywhere from battery cells, including offshore wind vessels, et cetera. So there's a lot of movement in that manufacturing. There's some significant credits that are provided there. And then we also have, aligned sometimes with the investment tax credit, carbon sequestration credits. So where are you taking that carbon oxide or carbon dioxide and storing it, and how are you storing it? And if it's done in a particular manner, you generate a credit. And then more recently, we're seeing an uptick in commercial vehicle credits. So that's, for example, one might be I work with Disney and Universal in Florida. I don't have electric buses. There's a push to look more environmentally friendly. Also, waste dump trucks to be more electric. So there's a variety of things going on there that people are engaging in that sector. Next slide. I just would like to remind you, I'm not going to get too much into the detail, but there is a significant change that's occurring at the end of this year in the clean energy space. We no longer are looking at the basic Section 48 investment tax credit, but we're moving to something called the Section 48E tech neutral credit, which essentially is going to be focused on electricity, the production of electricity under clean initiatives with zero greenhouse gas emissions. So things we saw this year that if they haven't started construction, that most likely won't be seen next year. Obviously, combined heat and power systems. But also there is a nervousness around biogas facilities, and will those fall in under 48E? And the one thing that's clear under the proposed regs is they potentially could, but that your life cycle analysis would have to include your carbon sequestration, and you'd lose that additional credit. So a lot of people have been in the safe harboring provisions throughout the end of this year, and we expect to continue to work through that through December 31st. Next slide. The other broad change that I think more and more people are becoming aware of, we've obviously been active talking to our clients, but we are seeing more and more emails about this subject, is the fact that taxpayers can buy, right, these credits from others. Meaning, I essentially am sitting there and I'm not going to be in the development stage. I'm not going to buy a qualified commercial vehicle, but I have a pretty big tax liability. And I can essentially decrease that tax liability by utilizing these credits. So on the right side, you'll see a variety of credits that are being transferred. We see a lot in the advanced manufacturing space. They don't want to wait until they file their tax return to get the refund, so they're transferring them earlier from a cash perspective. The investment tax credit we're seeing a lot of, and obviously carbon sequestration. The other significant difference that is still an aha moment. I was down with the New Jersey Health Association talking about this particular item to our not-for-profits and our Indian tribal organizations, and that they now avail themselves to the credit, meaning even if they have no tax liability, hospitals putting in combined heat and power systems, solar systems, buying commercial vehicles, are going to be able to receive a direct refund, a refundable credit, essentially, from the federal government for those actions. So now equate what I just said to the large amount of movement we're seeing in this space, it starts to make more sense. Next slide. So this is just saying, ignore if you're not a developer, what's going on in the buy-sell arena for these clean energy tax credits. And we're seeing significant movement. We're expecting, so as you can see on this slide, we're expecting to see at least $42 billion of action this year, only expected to grow significantly over the next 10 years. And 21 of that, or half of that transaction on the low end, is all done through the selling and purchasing, no complex equity agreements. It's just me saying, I'm a C corporation, I have a $10 million liability, I want to go out and buy $7 million of credits and get a 5% discount. So that's a lot of what we're working with our clients, especially with the due diligence regarding that. If you have someone approach you and say, here's a credit, and you only have to pay 40 cents on the dollar, run, because that is not in line with what we are seeing in the market. Next slide. This is again just highlighting that we have a significant amount of transferability that it's expected to occur. So again, hovering around 45 billion this year, but within the next 10-year projection, you're seeing it drastically increase. So assuming no major adjustments are made to the IRA, this would be the expectation as we go forward. Next slide. So the last thing I like to point out is a lot of people say, okay, I've heard about this now, and I heard about this from somebody that I was talking to in the business world. What does it really mean? I'll tell you the two highest targets are C corporations who have to pay a tax liability, and high net worth individuals who pay tax on their passive income or their passive income, meaning businesses they don't materially participate in, not dividends, not interest that you're earning from your brokerage account, but investments that you're not actively involved in. So here, I'm not going to go through word by word, but essentially, this is a C corporation. They want to go after a $7.5 million credit to utilize on their tax return. The nice thing about significant that some people forget, as long as you identify that at the beginning of the year, you can defer your estimated tax payments, meaning that I don't necessarily need to pay in because I haven't found it yet. So there's a time value of money there. And then right now, we're currently seeing trading values. As we get to the end of the year, we're seeing them more to the 95 cents, 96 cents. But depending on when you come in, you could see them as low as 92 or 93 cents. And so you're seeing, in this low-hanging fruit example, the person who's looking for 7.5 million buys credits at 94 cents. They've saved $450,000 just on the transaction alone, but also have been able to keep more cash in their piggy banks by decreasing their estimated tax payments. So a lot more movement this year. We're seeing an increase every year. So definitely something to talk to your advisors about. I'm going to pass it back over to Dan now.
Great, thanks, Lynn. And so we're going to switch gears here now and talk about the employee retention credit update. Been a lot of developments over the year. I'm not going to talk about so much the rules of the ERC. Most people are familiar with it by now. I don't think people, for the most part, people have applied, and there are very few new applications going in. But there was a bill proposed in January this year to cut off the filing deadline for the ERC. So it would have prevented new filings after January 31st of this year and would have extended the statute of limitations to 6 years. The bill stalled in Congress and never went anywhere, and it's still unclear if it's going to move after the election. The interesting thing about this bill that it was the only pay for in a $78 billion legislation of child credit and other provisions. And the other thing I'll mention is there was a moratorium, which we'll talk about in a moment, on a processing moratorium on claims. And when the IRS released that moratorium and started processing claims, they only went up to January 31st of 2024. So leading us to believe the IRS at least still thinks there's some chance they're going to get a version of this bill passed, because they're not processing those claims. They're trying to put it off, hoping that now that the election's over, they can get something in to shut off what they view as improper claims. On April this year, was a big day for many businesses because the statute of limitations expired on 2020 ERC claims. This means that the IRS can no longer make an assessment relating to a claim in 2020. So if you're one of those taxpayers that filed the 2020 ERC claim and weren't quite sure about it, put the money in the bank, you can obviously release it at this point and spend the money. There is a quirky rule for erroneous refunds where the IRS can file a lawsuit within 2 years of payment. So let's say your 2020 claim was paid in June of 23, the IRS would have 2 years to pursue you. So it's beyond the statute of limitations period. But that process involves the IRS determining they want to go after the claim. They have to coordinate with the Department of Justice, and they have to file a lawsuit within that 2 year period. So a lot needs to happen. The IRS has not used this process yet, and it's unlikely that they would use it except in perhaps the most egregious cases or in a very large case. So for most people, this is probably unlikely to worry about this, and the assessment statute that expired is the big one. So this means you can't, the IRS can't come after you for a 2020 ERC claim. You also can't file new ones at this point. If a claim is disallowed and the taxpayer wants to challenge it, they have to pay, the IRS has to pay or allow the claim within 2 years, or the IRS is prohibited from paying. So it's important that if you do have a claim that was disallowed and you want to challenge the IRS, the taxpayer has to wait 6 months before it files a lawsuit. But you have to get something done. You have to file that lawsuit within 2 years. Otherwise, you lose the right to receive that payment. There is a form for an extension where you can approach the IRS and ask them to sign Form 907, but it's unclear who you would approach to have the IRS sign that form. And the taxpayer advocate wrote some information about that, discussion about that form and how possibly you can get it signed. In July of this year, the IRS issued some guidance about tax-exempt entities and how the aggregation rule would work. I won't go into this in much detail. The interesting thing was everyone had thought there was an 80% overlap test that applied based on that regulation cited in that first bullet. The IRS took a more conservative view and said there's a 50% overlap test, which would more likely lead to aggregation. We don't see this come up a large amount in practice. But the IRS did take a position that a 50% overlap is enough to cause aggregation, presumably with the intent to then deny the ERC based on aggregation. Also in July of this year, the IRS began sending out denial letters, 28,000 denial letters. They give a variety of reasons which are listed here, but many of these letters were issued to businesses that were in fact eligible. And so that, for instance, some of our clients received a letter saying that we're denying your ERC because we don't think you were engaged in a trade or business. And these businesses have been filing tax returns for the last 15 years. So you wonder, like, what data the IRS relied on in its systems to make its determination. But so many of these are incorrect. I think partly the IRS is hoping that people will get these letters and do nothing and not file. They give them 30 days to contest it by filing a protest. That's later been extended, as we'll see, up to 2 years. But because the letters, not every letter included that 30-day deadline. In August of this year, the IRS announced that a limited reopening of the voluntary disclosure program. If you recall, this program was announced originally in November of last year. It expired on March 22nd. There was a 20% benefit, so taxpayers could receive they could keep 20% of their ERC if they returned 80% as part of the voluntary disclosure program. With this limited reopening, it's August 9th is when they announced it, and it expires November 22nd. So in a couple of weeks is when the expiration of this reopening period will happen. It allows taxpayers to keep 15% of the ERC, and they have to repay 85%. So slightly less generous terms than the original voluntary disclosure program. And we're seeing very few people take this up because most of the businesses who are thinking about it, they thought about it the first time around and either decided to do it or not to do it. So the second time, we're expecting much less uptake from taxpayers on this VDP. But I have had one client who decided to take advantage of the second, limited reopening of the VDP. In August of this year, starting in August and continuing now, we're starting to see the IRS announce it's sending an additional 30,000 letters to claw back ERC funds are already paid. So this is in addition to the 28,000 letters I just mentioned. And the IRS is really, they're coming after these things hard. If they believe that the claim is improper, they're going to deny it and then make the taxpayer come back and provide evidence to suggest they are entitled to it. So we've started to see these 30,000 letters. We're starting to see them come in now. And so they are out, and the IRS is coming after people. Just because you receive a letter, though, doesn't mean the IRS is correct. And in many cases, we're seeing they are not correct. So if you get one of these letters, it makes sense to talk to your trusted advisor, make sure you decide if you want to do nothing or to file a protest and contest the denial of your claim. Okay, so the IRS gave 30 days. I talked about in that initial denial letter. They've extended that to 2 years. They came out with on their website an explanation. They want more information than the letter provides. It's kind of a strange process. In the interest of time, I won't cover this now, but I put it here in the slides so you'd have it in case you want to download the slides and review them after. So what lessons have we learned? With them here, we've done over 30, probably over 60 audits at this point. We have over 100 pending. So we have a significant ERC audit practice. I put in here some lessons. I try and distill what I've learned over these many audits and the way these audits have progressed over the last few years. Essential businesses face an uphill battle on audit because they remained open. The IRS view is that if you were an essential business, it's very, very hard to justify an ERC based on a partial suspension analysis. If you meet the gross receipts test, you're likely to prevail on audit. Partial suspensions, if you're going to prevail, require taxpayers to point to specific governmental orders. You have to list the order and the number and to specific impacts on the business relating to that order. Not enough to say social distancing impacted my business or group gathering limitations impacted me, cleaning requirements impacted me. You need to explain exactly how those limitations impacted your business and led to a greater than 10% reduction in your capacity. Or in your ability to provide your goods and services in the normal course of business. Generalized claims will no longer work. They did early on in ERC audits, but we're not seeing them work at this point. Taxpayers that prevail usually have a very clear story to tell. They're able to say, for instance, I'm a nail salon and I had to use every other station, and then they explain the limitations that affected their business. But generalized claims won't cut the mustard anymore. So with that, I'll turn it over to Lynn to talk about start with digital assets.
Thanks, Dan. And I think Dan nailed it on the head when, recreating the documentation after the fact is very challenging. So it's important to make sure you have that audit package ready and raring to go, knowing that there is still a lot of perception that fraud is quite broad throughout the ERC claiming process. The next topic we're going to go through quickly, but if you are involved in digital assets, it is important for you and your advisors to be working through this. Essentially, what has come out recently is that the IRS has said before, when I had multiple, for people who maybe aren't in digital assets, if I had multiple accounts or bank accounts, right, but I have multiple what we call in the digital world wallets, they would allow you to potentially sell your digital asset from wallet A and use the basis for that same type of digital asset from wallet D. And as many of you in this space are aware of, the tracking of the basis has not always been clear and directive. And we've actually seen this as a starting point to get prepared for next year when we indeed will, brokers will have the responsibility to provide a form tracking basis. So essentially, what they have requested that people do who have multiple wallets or who have multiple locations of their assets is to somehow combine that orphan basis, right? So I have an asset sitting there where there really isn't an asset, but it has a basis value, and they're asking you to essentially align that to discreetly to a similar product. So this is something that they're requesting be done by December 31st of 2024. But they essentially said the latest you can do it is amongst your first sale of a digital asset in 2025 or by the end of the 2025 tax year. So a lot of people are working through this with their advisors. If you go to the next slide, Dan. So there's two different safe harbor mechanisms. The first is what we refer to as a specific unit allocation, which would be you identifying, the similar type of digital asset in another wallet and specifically moving that basis, that naked basis over to them. Alternatively, there's a global allocation where you can look at and reassign the basis and in a reasonable methodology. What's interesting about this is specific to people that use first in, first out. And what we've seen in this area is that sometimes the systems that the software systems that people are using, even though you might be using first in, first out, they might be using highest in, first out, right? HIFO to limit that. And it doesn't appear right now that this safe harbor methodology it could be applicable to them. The AICPA has written a lot of questions on this topic. Unfortunately, hasn't received a response yet, but an attempt to do this in the next by the close of the year is going to be important. Next slide. This is just FYI. We have it in all of our year-end planning documentation. We do have inflation adjustments that are worthy to be aware of. Nothing too drastic, except I would point out the life estate tax exemption increased from 13.6 million per person up to 13.9, so we're almost up to 14 million. And then the Social Security maximum amount of earnings jumped from 168,600 to 176,100. Next slide, Dan. A couple other things I want to point out. Many of you might be sitting there and saying, corporate alternative minimum tax, why haven't I heard about that? So I'm a C corporation. There's two reasons you haven't heard about it. One is they're looking for a 3-year average of your applicable financial statement income to exceed 1 billion. So that's generally, much larger corporations. But I would point out that to the extent that you're owned by a foreign entity, a foreign parent, there is a clause within the corporate alternative minimum tax that would make you be involved in this if the U.S. subsidiary without the foreign parent exceeds 3-year average exceeds 100 million. So that's how we're seeing more and more of our clients come into this space. It is a wacky calculation, as many of you know. It's not really based on anything tax. It's based on your applicable financial statements. They're looking for you not to use tax depreciation, but use book depreciation. There's a variety of rules here. Most recently, I would point out if you have a C corporation as a partner in your partnership, they did recently come out with pretty strict guidelines of what that partnership has to track and report to that C corporation entity or partner. That it could be very rigorous on top of the 704B books, the tax capital books, and et cetera, that partnerships are implementing. So really something to be aware of if you are a partnership, to know your partners and to know if that's going to be a concern. Now I'm going to pass it over to Dan.
Thanks. We have 1 minute left, so I'll be very quick. Beneficial ownership interest reporting is due by the end of this year. If you had an entity created before 2024, the filing is due by the end of December of 24. So there's not been a delay. The statute is constitutional at this point. So you do need to get those filings in by the end of the year. Keep in mind there are 23 exemptions, and we're finding that the most common 2 are large operating company exemption and tax exempt organizations. So there's others. There's 23 in total. Many of them involve large companies. I know we're out of time. Thank you for joining the session. We encourage you to join the other sessions, and I hope you enjoyed this one.
Thank you.